All right, let's get started. So welcome everybody to the fall member-only webinar. And just a reminder, I am recording this and I will send you a link to the recording, to Doug's deck, and to a spreadsheet that Doug is going to talk about. It'll take me a couple days to get that done, but by the weekend for sure, I will have it for you. So let me tell you a little bit about Doug. I'm going to let him give you his credentials. So Doug Kauffman owns Kauffman CPA. If you've been a member for long, you have heard me talk about Doug. He's an outsourced, he owns a company that is an outsourced CFO, but also bookkeeping for the last, 4 or 5 years now. So I had a CFO that was with my agency for more than 20 years. And when she decided to retire, which I thought was a very bad idea, I could not persuade her not to retire. And because I'm on the road all the time, it didn't really matter if I had a CFO in an office or not. And so we interviewed several firms and ended up with Doug. And I got to tell you, it's been magic. So Doug handles all the finances, bookkeeping, and CPA work for my agency, for AMI. He helped me with my real estate. So if you guys will mute, that would be great. Anyway, so I can tell you from personal experience what it's like to work with Doug, but Doug has also become a great advisor to many AMI agencies, works with a lot of our clients, has helped me put together some spreadsheets and dashboards and things like that we use in our peer group meetings. So I am always indebted to Doug. And so I know for many of you, managing cash flow is a challenge. And so when I was putting together the 2021 webinar series, I asked Doug if he would talk about cash flow, and he kindly said he would. So with that, I'm going to just remind you, in case you just popped in, yes, I'm recording this. Yes, I will send you a link to the recording, to Doug's deck, and to a spreadsheet that Doug is going to talk about. I'm going to be monitoring the chat, so really I'm going to go quiet in a second, but I'll be monitoring the chat. As you have questions, please feel free to ask them there. Doug did allow some room for questions at the end, but you feel free to ask questions throughout, and I will interrupt Doug when it sort of seems like the appropriate moment to do that. So if I don't ask your question right away,
unless I
mute, Rusty. Thank you. Everybody, if you'll mute yourself, that would be lovely. All right, Doug, if you will go ahead and share your deck and take over, I will be the color man in the background.
All right, sounds good. Thank you, Drew. Thank you, everyone, for jumping on here today, and really appreciate the opportunity. Hopefully, you can see my screen here. This point,
see it, Doug.
First deck,
Yep.
there, perfect. You know, I've equally appreciated the relationship that I've been able to build with Drew here in the past 4 or 5 years, and you know, he says he's indebted to me. That's absolutely not true. We're forever indebted to him for you know, setting us up with such a wonderful network and introducing us to a lot of the clients that we work with, really. And you know, one thing that I really like about working with AMI clients, or clients that are at least familiar with AMI, and you know, even if they just listen to the podcast, they're educated. You guys are educated, and you know, you're here today because you want to learn something. So that's what my goal is to jump in and teach a little bit about cash flow. This stuff is not rocket science. This stuff is, you know, things that I've learned running my business, the stuff I'm going to share with you. Anytime there's best practices or things like that, it's either because I've seen somebody else doing it, or I've tried it myself and come up with what I think is a good way to manage some of this. So we'll go ahead and jump in here. Yeah, there we go. Okay, so yeah, a little bit about me, not too important. Yeah, I started the company about 10 years ago, no, a little bit less than that, about 8 years ago. There's 9 of us. We're in and around Lancaster, PA, for the most part, which is between Philly and Harrisburg. Our mission, that is important. Our mission is to deliver financial clarity and peace of mind to creative agency owners. So cash flow is one of those things that can lead to not having peace of mind. There's a couple of statistics to start us out. These were studies done by US Bank and JP Morgan Chase of couple 100,000 small businesses. So not just agencies, but just small business in general. So the businesses, if a business failed, and it was part of that study, 82% of the businesses that failed said it was because of cash flow. And that was the highest. That was by far the highest reason that was given. You've probably heard statistics about, how much the American household has saved for a rainy day. It's like, less than $1,000 for most American households, which is bad, really bad. For small business, it's 27 days cash on hand. So we'll talk a little bit about what a good number is there. But I'll give you a hint. It's higher than 27. So it's saying that, if they needed to, they'd have $27 days worth of cash available to keep running their business. If revenue suddenly declines significantly, it's not very much time. As you know, as business owners, it's hard to make a decision, a good decision, in 27 days and kind of turn the ship around. And over half the companies surveyed said they lost 10,000 or more due to cash flow. So we've got a problem, or at least we've got an item that can lead to problems. So my goal here for today is to show you how to fix cash flow problems, or at least to deal with cash flow problems, and hopefully never have to worry about cash flow again. There's so much more to life than business. There's certainly more to life than staying up at night worrying about the cash flow in your business. Cash flow in the larger picture of business finance is complex. Just like marketing is complex in a business environment. There's so many things that you can do. There's so many different strategies and approaches. Finance is not unlike that in many ways. So what I want to do is try to build a little bit of a framework and help each of you self-assess a little bit where you might fall in that framework. And then based on that, give you some things that you can potentially do differently to hopefully improve your business finances, hopefully manage your cash flow a little bit better. I'll also finish by saying, or finish this slide up by saying, I'm of course a believer that when it comes to this stuff, business owners should hire somebody else to do it. If I didn't believe that, I wouldn't be in business. I'm equally as much a believer that businesses should hire you folks and outsource their marketing and focus on what they're good at. But beyond that, I also believe that the best clients that my business can get, the best clients your business can get, are those that are educated. So you don't necessarily have to take what I'm talking about today and say, oh man, I got to go learn how to do all of this stuff. I really don't want you to have to do that. I just want to educate you in a way that you can go hire someone, or you can work with someone, or you can empower someone already on your team to help you do these things better. And maybe some of it you do for yourself. Maybe you really enjoy doing it for yourself, and that's okay. But if you don't, this will hopefully educate you rather than give you a list of things that you have to walk away with, where it's like, well, now I've got, I had 99 things to do today. Now I've got 101 things to do today. I don't want that to be the case. I want you to just get a little bit better understanding here. So let's start with a little bit of a framework, and then we're going to dive into this as we go through the presentation here. And I'm going to flip back and forth to a spreadsheet a little bit. Like Drew said, you're going to have the spreadsheet. We call it our agency toolkit. It's evolving and changing over time, although I think we've landed in a place where it's pretty good thing. If you're part of an AMI network group, you will have already seen something similar to this that Drew is using for the quarterly reporting. The one that I'm going to use and that'll get sent around is more of a monthly reporting cycle, and it's got some tools in it that you can use for this. So the framework for cash flow, the framework for financial health in business, is really can be visualized in this pyramid that we have here on the screen. At the base, at the foundation of a business with finance, you've got profit and loss and cash movement. It's really that simple. Did you make money? Was cash flow positive or negative? If if you don't know the answer to those questions, we got to start there. That's the baseline. We've got to be able to answer those questions every month. That will lead to additional conversation. The next layer up, or the next section there of the pyramid, is what I've termed the clarity layers, and that we'll dive into a little bit more. But that simply means that you're going a level deeper than did we make money or not? Did we have positive cash flow or not? You're starting to get into things like, what's my profit by client look like? What kind of ratios do we have? Some of that type of stuff. We'll dive into that a little bit deeper. And then the top one is more fine tuning. And I should probably have a line there between the top one and the next one down. But really, there's almost a switch in that fine tuning one to where you've got all your historical information at a place where it's really valuable, it's completed timely, it's presented in a way that you can look at it and interpret it. The fine tuning then becomes being able to look into the future and project or plan for the future based on what you know from the past. It's all got to build on top of itself. You can't fine tune if you don't know how much money you made. It's just that simple. So let's dive in a little bit. Step one, profit and cash flow. It's pretty simple. It sounds pretty simple, but I understand why it gets complicated. So the very first question is simply, how much money did we make? Was the business profitable or not this month? And if you feel like you can't get that answer, or you know that the answer you're getting is not accurate, it's got to be fixed. It is so fundamental. And the other thing I would say is, if the answer to that is we did not make money, that's a big deal. Especially in a professional services business where your major asset is your people, you're paying them. If you're not making money, usually that's indicating some sort of a pretty serious problem. Either you've got way too many people on board, you're way overspending on overhead, or your revenue has declined significantly and you haven't made the necessary expense cuts. So if the business is losing money, that's a serious deal. If the business is making money, great. Like then you've conquered. If the answer to that is, yep, we had profit. Okay, now now we're ready to go to the second layer in this world. Second question, again, still in that first layer. Was cash movement positive or negative? So do you have more cash at the end of the month than you had at the beginning of the month? The answer to that may not always be yes, but by and large, if your business is growing, you're going to continue to need more cash on hand. So by and large, the answer to that question should be yes. Once again, kind of like the first question, if the answer is no, okay, what's going on? We got to dive in. We got to talk about where's the cash going out the door, kind of thing. If the answer is yes, great. We're ready to go to that second layer. Let's start looking at some other things. Let's start optimizing or improving now that we've cleared that first hurdle. And the third one in the first layer is, how many days cash on hand is there? And that's pretty simple. That calculation is just looking at how much do you have, what's your total expenses for the business, and how much, and including payroll, overhead, everything, all the cash that goes out the door in a given month, and how much cash do you have on hand compared to that. So take your total cash balance.
Hey, somebody, hang on, Doug. I'm gonna mute everybody, and then whoop. Okay, now the ticking is done. So never mind. Keep going. It was an ominous sound, the ticking of the bomb, as we're talking about money.
I did hear that. I was like, man, what am I?
Want to just nip that in the bud.
Thank you. So the cash on hand, just how much cash do you have divided by your total operating expenses? We're looking for a number greater than 2 there. So 2 months worth of total cash on hand at any given time is going to give you as an agency owner enough of a runway to deal with any crisis that you might run into. So if you think back to...
Doug, I'm going to interrupt you for just a quick sec. So as all of you know, that's exactly what we teach at AMI, unless you have a gorilla client. So if you have a client, somebody said, hey, that was Blinker. They're Zooming, they're doing financials and driving. That's a dangerous combination. If you have a gorilla client, a client that's more than 25 or 30% of your AGI, then you're going to want to have more cash on hand. And Doug, I may be preempting you here because if that client goes away, you need a bigger runway to pivot and to deal with whatever the ramifications are of that loss. So I'm going to go back into the background, but I just wanted to jump in and remind you that Doug's exactly right. If you have a balanced portfolio of clients, 2 months should be plenty. But if not, you're going to want to have more. Now, again, what we teach at AMI is you're going to keep 2 in the business, and you're going to keep another 1 or 2. You're going to take it out personally out of retained earnings, but you're going to keep it in some sort of a liquid account that you could lend back into the business if you need to. But you want to do it as a loan, not just you infusing cash into the business. So, all right, now I'm going to be quiet. Doug, sorry, you're back.
No, that's great. I don't go into, I don't have anything specific about that level of detail here. However, you're exactly right. So this is kind of the rule of thumb, and then you do have to apply that to your business. And on the flip side of that, if you're a business that's got a whole bunch of retainer clients that are all relatively small, no one more than 5 or maybe max 10% of your overall revenue, maybe you can actually even go a little bit lower than that and still be safe, just because it's highly unlikely that those clients are all going to walk out the door all at once. It never hurts to have at least 2 months on hand. You're not going to lose that much money in interest, or you can't make any money in interest income now anyway. So it's going to give you peace of mind to have that much on hand. If you get up into the world where you're like 6, 8, 10 months cash on hand, you probably got too much. It's probably time to take that money out and put it to work somewhere else. Talk to a financial advisor. So make sure you're funding your retirement. It's a great problem to have, but don't just let it sit there, because it'll be an unnecessary security blanket. We've seen that happen too. Business owners will keep too much cash on hand, or will build up to too much cash on hand. Something happens where if they didn't have that cash, they would have made a quicker decision that probably would have been a better decision. And you just sit on it because you're like, well, we got 10 months cash on hand. This will probably just fix itself.
Doug, that is such a critical thing. When we get too fat and happy with our checking account or our savings account inside the business, you guys, especially when it comes to reducing staff when you should, or reducing expenses when things are getting tight or a big client goes away, you make some tough decisions because you think you're sitting on all that cash. But frankly, in most cases, that's your cash that you've already paid taxes on, and you should get it out of the business rather than peter it away with a bad decision. So again, totally agree with Doug's assessment.
Yeah, and the PPP loans have put a lot of businesses in a position where that is the case. Before, obviously, COVID really hurt a lot of businesses as well, but there were plenty of businesses that got PPP loans completely legitimately. But it turned out that they really didn't need that cash, and they're still sitting on it. So now we're at a point where it's time to put that cash to work, if you haven't already. So before we go a little bit further, I want to make a distinction here, that cash is not equal to profit. And if you've heard me talk before, you've definitely heard that before. I know Drew talks about this as well, but I feel like it's such a key foundational thing that if you look at your business and just simply look at cash, there's a lot of things that can happen where your cash will move in ways that your profit will not move in. And that's really important, because cash, while it's important to have that in the business, I would argue that in the agency world, where you have rather simple balance sheets, you don't have inventory or manufacturing or fixed assets really even. If profits are in line, cash will follow. So if your business is profitable at the level that it should be, the cash is going to follow, with few exceptions. So it's key to remember that when I'm talking about profit, I'm talking about accrual basis profit. I know that's an accounting technical term, but it simply means lining up your revenue with your expenses. It means recognizing your revenue in the month that you earn it, recognizing your expenses in the month that you incur it. The benefit to that is going the whole way back to the very first thing. You are able, at the end of each month, we are able to look at a financial report and say, I know exactly how much money I made last month. Now, how did the cash flow flush out as a result of that? So This is how most business owners feel about cash not equaling profit. Why does cash not equal profit? Well, a couple of reasons. And this is the main reasons that cash doesn't equal profit. You got accounts receivable. So you might bill a client and they pay you 3 months later. Hopefully they don't, but they might. And so on your financial reports, you're going to recognize that revenue when you bill them, assuming you did the work that month. They're not going to pay you for another 3 months. You still had to pay your employees. Your cash is going to lag behind your profit. That can be a problem if you don't have cash reserves. Client prepayments. So what if a client prepays you $50,000 for a website? You're going to earn it over the next 6 months, but you get that cash in the door on day one. Well, now your checking account balance looks great, and you go and start spending some of that money, only to realize that there's not enough left over to pay the subcontractors or the employees to finish up that website. So again, focusing on profit, not necessarily the cash movement. Be aware of the cash movement. Don't run your business based on the cash movement. Owner's draws are another reason why the profit that you see in your business is not going to be the same as how the cash moves each month. And debt is another one. Although at this point, you might have an EIDL loan. We don't see a lot of agencies with debt. If there is debt, a lot of times it's a buy-sell agreement where an agency has bought another business. But debt payments, principal debt payments, are not going to show up on your profit and loss report when you're looking at how much money you made, but you still need that cash available in order to pay back the debt. So just a key thing that I like to look at there a little bit as we talk about some of those things. So let's move on to kind of step two. So let's kind of to summarize step one. You figure out, did we make money or not? Are we profitable? Well, yes. Okay, we're profitable. Great. We captured that one. Was our cash flow positive or negative? Well, cash flow was positive, and we didn't have any big prepayments. It looks good. Cash flow wasn't positive because we got a whole bunch of money in that we need to set aside, or even if it was, okay, great. Let's be aware of that. Let's set it aside. We're good to go. We got profit, got positive cash flow, we got enough money in the bank to cover 2 to 3 months worth of operating expenses. We've cleared level one. We're ready to go to level two and move into what's the next level of figuring out how to manage cash flow, how to know how the business is actually doing. So here's where I'm going to jump into the spreadsheet a little bit. I'll run through these quickly and then jump into the spreadsheet and show you how we go through these with our clients, how Drew looks at some of this stuff with AMI members. But the next layer is these types of things. So what are the trends in the ratios look like? Now we're talking about, yeah, great, we made a profit, but why are we making a profit? Or we had maybe we had a loss. Why do we have that loss? Looking at things like a little bit of a projection. How much cash are we going to have in 13 weeks? We know how much we have now. How much are we going to have in the future? Looking at things like who are the most and least profitable clients in the business. That one's always a tricky one because there's a lot that goes into calculating that. There's a lot of good record keeping that goes into calculating that. But I would say for the clients, when we've done those reports and the data has been accurate and timely, that proves to be one of the most useful reports that you can run as a business owner. It doesn't have to be clients either. I mean, you can insert something else there if you've got divisions or services or you're not gonna have products, but something like that. Clients are the world that most often makes sense in an agency where we're actually going to run. You can actually run a report that says, here is how much revenue we got from this client this month. Here's how much cost we had into it. Here's our AGI. Here's how much people cost we actually had going into this client. And here's what's left over from this client. And what does that look like when you start comparing a full report of all of your clients? You can very quickly see which ones are good and which ones aren't. You probably already know. But when you've got real numbers behind it, you can then take that to your team and say, hey, guys, these are good. Let's go get some more of them. These are not so good. what are we going to do? Are we going to, then it starts a conversation. Then you can say, well, are we going to increase their price? Are we going to, review what we're doing for them, make sure we're most efficient as we can be, or it's a lost cause. We're gonna help them find, one of our competitors that they can that they can make really successful. So it can be a really eye-opening report. One of the big things that goes into tracking something like that is time tracking. And again, it is something that Drew does talk about. Tracking time is just kind of a hassle. It's a habit thing. And if you're not doing it, I would encourage you to do it within your agency. There is a ton of great value that you can get out of time tracking, even way beyond who are my most and least profitable clients.
Absolutely.
And it can be done in a way that is not a look over the shoulder type thing. And kind of the myth there is that, well, I don't bill by the hour, so I don't have to track my time. I don't have to track our agency's time. I would say, yes, you do have to track your time because the amount of data and value that you'll get out of having that information is going to, is going to be absolutely worth the little bit of headache that goes into tracking something like that. So tracking time by which clients you're working on, and if you're not working on a client, still tracking time as to whether or not you're doing internal work at the agency. That's kind of the layer that we go to. Don't overcomplicate it. You don't necessarily have to track time by, the specific service that you're doing, especially if you're not doing it now. Don't feel like you have to dive in and make it super complex. Just how much time did I spend today on client 1, 2, and 3? How much time did I spend on internal agency stuff? You'll get all the data you need to move in the right direction. Maybe once you have 50 or 100 employees, then you start tracking at a more granular level, and that can be helpful. But you don't need that right now. The last thing there is how much money can I take out of the business? We really talked about that a little bit here in the past, in that you can take an amount out based on how much cash you have in. You can look at that, how many months cash on hand do I have, and base it somewhat on that. So let me jump into the spreadsheet here a little bit, and we'll talk about trends and ratios just briefly. Hopefully you can see the spreadsheet now, Drew. We good there?
Yeah, it's a little small, but if everybody squints, they can see it.
All right, let me help you out here a little bit. So
there you go. Maybe it's just my old eyes.
So a couple of ratios that are worth looking at when it comes to your agency each month. And again, if you've been part of AMI for any length of time, you've heard all of this stuff already. This spreadsheet makes it kind of easy to put it all together. And you can give this to somebody in your firm or to whoever you work with for accounting stuff, and have them just plug the data in and look at it. But first tab is just plugging data in. We've got exactly what you're looking for there. Second tab is agency ratios. We're going to look at the AMI ratios. Hey, what was my percentage of people expense compared to AGI? What was my percentage of overhead? My net income percentage. And then the last one here is one that we'll talk about as kind of the fine tuning, a value to owner item, which is something that I find is a new concept for a lot of not just agency owners, but small business owners in general. So I'll talk through what that means briefly to make sure you've got an understanding there. But the value in looking at this information over time is that you can start to see some trends. You start to see how things are actually moving in your business. You can also see if things are way out of line for where you want them to be. It tells you as an agency owner what you should really be focusing on. So, maybe that people expense is 65, 70% for a couple months in a row. Well, that's gonna clue you in to the fact that something is going on where either revenue's dropping or people expenses outpacing revenue, and it might be okay for a couple of months, but if it continues that way, it's going to be really hard to make money. Same thing with overhead. That hasn't been a problem in the last year because Nobody could spend money on discretionary things like travel and entertainment and all of those things, but it'll come back around. There'll be a point where that'll be an issue again, and spending in those areas will spike back up as well. Like I said, we'll talk about value to owner a little bit. You want to look at AGI per full-time equivalent. That just gives you an idea of whether or not you've got the right number of people on staff. It's very much related to the people expense ratio. It's just a little bit different way of looking at that. Kind of a quick, easy way to figure out, hey, do we have the right number of people on our team? And then down here, a couple of balance sheet ratios. So, we talked about months cash on hand. If you plug the numbers into the spreadsheet, it's going to give you that number right there. You can just look at it again, see how it's trending. Oh man, we're at 3, but we've been trending down for the last 6 months. Well, we must be bleeding cash somewhere. What's going on? This is eventually going to be a problem. So pretty simple, quick and easy way. If you look at nothing else on a given month, if you just look at something as simple as this, it's going to give you a pretty high level snapshot. It's going to let you as an agency owner know if there's things that are not where they need to be, then maybe you can step in and deal with those things. Or it's going to let you know, yeah, things are pretty good. I can go focus on other areas of my business. I can focus on retaining my team. I can focus on sales or whatever else it might be. You don't have to feel like you need to dive into the financial reports quite as much, which is probably not something you enjoy doing that much anyway. Get the high level. If it's where it needs to be, go do something better with your time. The other thing that I have there in layer 2, so to speak, is a cash flow projection. So that's this second or third tab here. This spreadsheet is really meant to be a toolkit. It's meant to be, you can use the tools in here that you find helpful. You don't have to use them all. You don't have to use any of them. But I think a lot of these things are helpful in conquering and managing cash flow and agency finance as a whole. So the cash flow spreadsheet is just simply saying.
Hey, Doug, can you make that bigger again for my eyes?
Yeah, sure. Thank you. The cash flow spreadsheet is just simply saying, hey, on a weekly basis, what's going to happen with my cash flow? I'm starting at a certain number. I've got things coming in. Usually that's broken down by actual clients when they're going to pay. I've got things going out, and those are generally very easy to predict. You know what payroll is, what taxes, what rent, when your credit card payment is and when it's going to be. You can predict what you're going to draw out as an owner, tax payments. All those things are relatively easy to predict. Once you get something like this set up, you can roll it forward, or it can be rolled forward in 10 or 15 minutes a week. And the benefit is you go out to the end and say, oh, okay, 13 weeks from now, yeah, we're going to have a good amount of cash on hand, or no, we're not going to have a good amount of cash on hand, but at least you know. A lot of times business owners have no idea, and it's the weeks are just kind of coming at them, and they're not able to actually look at this. This goes to the peace of mind side of agency finance, where once you know that number, then you're able to rest easy at night. You don't have to get stuck thinking, oh my goodness, am I going to have enough cash? Can I really afford to hire that new employee? Oh, we're going to hire somebody new here, so that's going to be another $3,000 every 2 weeks. All right, well, no problem. Plug in the 20,000 and run it out starting on that week. Where does that put us for cash? And it's really useful if cash is tight, in the sense that if you're going to have trouble making a payroll, if you know about it 13 weeks in advance, it's a lot easier to solve that problem than finding out Wednesday on a payroll week. So it's especially helpful if cash is tight in your business. That has not been the case so much in the past year for most businesses, just because of the funding that's been available. But I still think it's important. It gives you a level of clarity and peace of mind. I do this for my business. Once a week, I go in, I update a cash flow projection. It's to the point where it takes me 5 minutes. We do this for some of our clients where we'll update it or we'll help them update it. It leads to a lot of value, just knowing where you're at.
Hey, Doug,
at the end of
how conservative do you recommend everybody be in terms of projecting out? So is it only signed scopes of work? Is it only people that have contracts or a deposit's been made? Or is it more speculative? Like where do I draw that line in terms of doing this?
Yeah, that's where the art rather than the art rather than the science comes in. Anytime you're predicting the future, there's always that art aspect. I like to take the approach of saying, let's put money on here that we're reasonably certain we're going to get. So reasonably certain to me means the client has said they're going to do it, and you trust that that's true. You truly believe they're going to pay you. You're going to get that money in the week that you're going to get it. And on the expense side, go a little high. There's in my mind, I would say there's no value in trying to be aggressive with something like this and tricking yourself. It's right. Not gonna. There's no benefit. So why not be conservative? Look at this and say, okay, well, we do need to go get that revenue. We need to get that sale 2 months from now, because cash is going to be a little bit tight. We lost a client, and that means a decline. Or hey, we've got a whole bunch of clients that are signing. Cash is going crazy. We're gonna need to hire, and yeah, let's plug in those numbers and see what that looks like. So be reasonably conservative on the revenue side. Yeah, we're pretty sure we're going to get that money. On the expense side, be reasonably aggressive in the sense of like, hey, this is probably the worst case scenario for what we're going to have to spend here. All right, let me see if I can jump back over to my slideshow here.
So Doug, a quick question. Do you tie new business projections with predicting cash flow?
On a short term.
Hang on, Gordon. Yeah. I just want to verify. So what you're asking is, you haven't won the business yet. Should that be part of your cash flow predictions? Is that what you're asking, Gordon?
Yes.
Okay. Yep.
When we're doing a cash flow projection, we generally don't. I won't, die on that hill, so to speak. But simply by the nature of this being a rather short-term prediction, we'll generally just update it based on known information for the next 13 weeks. Now, if you're doing a longer range income statement projection, which is the very next tab on that spreadsheet, then yes, that's where you do start to pull in that. What is the reasonable growth expectation? What is the, how much do we think we're actually going to have? And you can still look at how that's going to impact your cash in the long term. It's just not going to be nearly as accurate as that short-term projection would be over just a quarter of the year. I'm going to skip through this just quickly. So we'll move into step 3 here, and some of the fine-tuning stuff. So once again, kind of summarizing where we've come from. So step 1, did you get your are you profitable? Is cash flow positive? Do you have enough cash on hand? Great. Step 2, okay, what's the next layer? Who are my most and least profitable clients? What can I do to to project and see where I'm going to be at the end of the next 13 weeks? How much money can I actually take out of the business? And that's the stuff that I skipped over there quickly. It's a formula that'll help you figure out how much money you should be taking out based on profit each month. Like I said, you can always just look at how much cash you have on hand as well, and base it on that at the end of a month. The flip side is also true. Unfortunately, if your business is losing money and bleeding cash, yeah, you might have to start putting some money into it. It's great that Drew recommends having cash outside the business that you can potentially loan in. You kind of become your own bank, and saves you a little bit of a headache there in trying to get a line of credit or something when your business is experiencing a downturn, which is, by the way, the worst time to try and get a line of credit. Banks are backwards in the sense that they like to loan money to people who have lots of money. But it's just kind of the way it is. So you get through those things. Now you're ready for step 3, some of the fine tuning.
Hang on, Doug, good question. How do you factor in collections, especially on-time receipts? Is there a rule of thumb or is it based on trends?
It completely depends on how your business is set up. So some businesses, it's a lot easier. You've got retainer clients, it's going to be a lot easier to just say, hey, they pay beginning of the month, or they always pay by the 15th of the month. We charge their credit cards. If you're doing big projects and payments are kind of all over the place, you can look at trends and predict it that way. Although what we've found is that a lot of times, if you're just going out 13 weeks, or maybe even scale that back to 10 weeks, you can do pretty well at just going client by client and saying, here's when, based on everything we know about this client, this relationship, this project, here's when we can reasonably expect to get cash in the door for that. That's how we do it most often, is kind of an actual expectation versus a hey, we get paid 10% in the first week of the month, we get paid 50% in the second week of the month. That works well for large business with small transactions. A lot of times it doesn't work quite as well for an agency. You'll find that it's hard to be accurate. All it takes is one big client not paying the week that you think they're going to, and it throws the whole thing off. So I like to go down to the individual clients or projects. Yeah, keep the questions coming. Please interrupt if you've got questions here, and I'm getting close to the end, so you can fire away at that point as well. So step 3, some fine tuning and best practices. These are things that, like I said, we've either seen other agencies do well, or we've kind of tried ourselves, and it's been really helpful. So the first thing there is one that really happened here in the last year or two, and that was the idea of, as much as you can avoid erratic or sporadic revenue, it's going to help your cash flow. It's going to help your overall agency financial situation. So through the pandemic, and even before that, the agencies that we see that seem to consistently do the best and consistently, and have owners who are able to consistently, not be reacting, but be more proactive, are those that have figured out how to charge on a retainer model for whatever it is that they're selling. We've seen agencies charge on a retainer model for just about everything. Drew would definitely be a great resource for that, in talking through, if you're billing and you want to move to that model, but you're not there now, how have other agencies done that? But what we've seen is that the agency is just going to be healthier. And if those agencies saw a lot less downturn when the crisis hit, and there'll be another crisis, we all know there will be, when the crisis hits, it's not an immediate panic. There wasn't 10 website builds in the pipeline that all said, nope, not doing it anymore, push the pause button. The retainer model, the ongoing revenue model, seemed to work. And like I said, we've seen agencies build websites on retainers. You don't have to, even if you think you've got something that is project only work, there's ways to spread that out and make that revenue come in based on when you're doing the work. It doesn't necessarily mean there has to be a long-term retainer there, although that is kind of an added bonus if you can do that. But just spread the revenue out, spread the billing out, spread the collection out over the period of time that you're doing the work. It makes it a little bit easier to manage those things. Second thing is do your absolute best to just eliminate accounts receivable. I know it's not possible. Every time I do one of these and say that, somebody raises their hand and says, well, our industry is, and then fill in the blank. And yep, you truly are going to have to do accounts receivable because you're working with big clients or whatever the case might be. But a lot of us, myself included, tend to become banks for our clients, and there's absolutely no reason to do that. We're in a world where your clients are willing to pay up front, they're willing to pay by credit card, they're willing to pay by ACH transfer, and maybe it doesn't even mean going back and doing that for your existing clients, but start doing it for new ones, and it can be a really simple change. You change one paragraph in your contracts and give the client one additional form when they sign up, and you can charge their credit card based on the schedule that you've set out for them. So as much as you can, eliminate accounts receivable. The amount that you pay in credit card fees will all be eaten up if just one client doesn't pay you each year. So don't worry about the credit card fees, because all it takes is one client not paying generally to cost you more than what it does for that. Plus, it's going to let you sleep easier at night knowing that that money is actually coming in. Plus, it's going to keep your team from having to make phone calls and get into that world of like, well, we worked together with this client, now I got to call and be the bad guy. It just creates so many positive things in cash flow world, and very, very little negative when it comes to just saying, hey, we're just not going to do accounts receivable. We're going to pay us up front or pay us on a schedule. I actually just talked to an agency owner earlier this week who was doing website projects, and he said that they have started for their websites, they will bill on a schedule, and not a schedule of work completed, a calendar schedule. And they started doing that because they found that some of their clients were just dragging their feet, and they were able to, when they started handling it that way, the clients actually got back to them more quickly because they knew that they were going to be paying for it. So because they were paying for it, because they knew it was going to be coming out of their checking account, they actually turned around the information that the client needed, or that the agency needed, more quickly, and it kept the project on track. Without just kind of naturally, because they knew that it was going to be paid for. Of course, you still got to watch, getting to the end of the project and not being done, but it was an interesting option. I hadn't heard of anybody handling it that way in the past. Number 3 there is track value to owner and discretionary cash flow. So that is, and then the 4th one is monitor capacity and billing rates. I'm going to jump over to the spreadsheet again very quickly and finish up with this. But these are 2 things that can be useful and often go overlooked. So value to owner, discretionary cash flow, it's really the same thing. It's basically saying, hey, as a business owner, you're going to have some sort of tax strategy in place. You're going to be on payroll. You might not be on payroll. You're going to have, certain things running through the business because you can. You might have kids on the payroll, health insurance, the business pays for your car, a vacation home, different things that can be legitimate tax deductions. But when you look at your profit and loss, it's really not a business expense. It's value that you're getting out of the agency. And tracking that can be really helpful because it does 2 things. One, it tells you how much the agency is actually generating for you. So it's a number that you can't find on a financial report unless you do some math, because you've got your profit, but then you have to add back in. That's what I'm showing on the screen now. I'll make this a little bit bigger. You have to add back in things like the owner compensation. You have to add back in other value to owner amounts. You can see I've got a note there talking about that. It gives you a total value to owner. The benefit to that then is you can take that value to owner number, divide it by your AGI, and track that over time. It's beneficial in that way in and of itself, in the sense that you can see how that's trending. A lot of times as a business grows, that will trickle down if it's not monitored, which just means a lot of times you're working harder, but for maybe you're making more money, but not proportionally as much as what you should be to continue to be healthy. And the second reason that that's important is if you ever go to sell your agency, have your agency valued, or ever looking to figure out how you match up against other agencies, it's a way to right size it. So anytime there's a buy or a sell situation with an agency, they're probably gonna use the term discretionary cash flow. It simply means how much money is this business generating for the owner, and if that's in the world that the buyer is looking for, then they're going to move on to things like, okay, are you involved in the business? How easily can we, how much does the business continue without you there? But if that value to owner number is really low as a percentage, that alone can be a tough thing to get beyond if you're trying to cash out of your business, so to speak.
Hey,
And
Doug, heads up, you got about 7 minutes at the top of the hour. We can continue on, but I know you want to get to questions.
Yeah, so the very last thing is this capacity calculator. You can look at this on your own, but can you
make that a little bigger, Doug? Sorry,
yeah,
hold eyes.
The goal of this, by now I should know too. The goal of this thing is to help you calculate how much capacity your agency has. So it walks you through plugging in some things like, what's our billable rate? How many full-time equivalents do we have? What's our effective billing rate? There's notes in here of how to calculate all that stuff. The whole goal is to figure out how much revenue can we actually serve with the current team or the team that we're building towards. Maybe you plug in an additional FTE if you're hiring somebody. And then the bottom part of this is a billing rate calculator. We often get a question to say, well, what should we charge? We don't charge by the hour, but we do our quotes based on the amount of time we think it's going to take. What should we be using when we're plugging in hours for the team? This will help you figure that out. Again, it's got some notes there to tell you what to plug in. If you get into this and you're trying to do it and you're not quite sure how it works, Drew, you can feel free to include my email address.
I will indeed.
And feel free to reach out to me. I'm happy to walk through this if you're getting stuck, but it can give you some valuable insight into some of those things that that are really that like fine tuning. Okay, now we're diving into some of the weeds of this. We're really going to try and optimize the business rather than just focusing on what was happening in the past. So let's move into questions.
So just a reminder, a couple of you have asked me in private messages. Yes, I will include the spreadsheet on the landing page where you can watch the video and see Doug's deck. So you will get this spreadsheet as well. What questions do you have for Doug as we wrap up today? Hopefully this has been super helpful.
Hey, Doug, it's Casey. My question is that, we have kind of a smaller set of clients. They're all on retainer and it's kind of larger amounts. And some of them have started to pay quarterly. And even sometimes those quarterly payments might be a little late and miss a quarter. So that's throwing things off for sure on a monthly basis and sometimes on a quarterly basis. So my first question is, for me, it feels like I've got to run these just on a quarterly basis, unfortunately, because we're, way up one quarter and then down the two others. And then also like when they miss or a payment is late on a quarterly basis, that makes that quarter look really bad. I'm wondering how do you like annotate that? So like next year, I'm not looking back and, thinking, oh, Q2 was terrible. I'm just curious how, I feel like I have a need to put annotations on a lot of my spreadsheets, and that gets pretty unwieldy. Any thoughts around either of those two questions?
Yeah, I'll try not to get too technical, but the answer is accrual versus cash basis accounting.
Okay.
And
absolutely, all of you need to be on accrual.
Oh, okay. I'm surprised
for a book. You do whatever you want for taxes, but for book purposes, accrual accounting is the key. And Casey, what that would do is simply say, hey, we're getting $25,000 over 3 months. We're going to recognize, that was a bad example, $75,000 over 3 months. We're going to recognize $25,000 of revenue each month. And then when that actually happens through entries in your books, then when you run that profit and loss, you're looking at that so that your profit reflects what you're actually earning. The next step then is to go to that cash flow side of things and say, okay, is this going to create a cash flow problem if they pay this way? but the profit part is fixed through accrual basis accounting.
Yeah, all of you should be on an accrual basis, and then most of you convert to cash for tax. Yep.
Cool. Awesome.
Other questions for Doug? You can either put them in the chat or you can just unmute yourself. You guys have this all figured out. Got all the cash.
I didn't even show my last slide. While they're typing, I'll show that. So back to the beginning, this stuff, I don't want you guys staying up at night thinking about this stuff. And that the picture there, I put that in there because that's what it represents for me. When you get it figured out, and you're not stuck worrying about it, you can go do things. That's me and my two boys. We were fishing down in Florida last year, and if you find yourself worrying about your business when you should be out doing things with family and friends, do something, change something. And this is always a good reminder for me to say, hey, I want to run the business in a way, like I said, the stuff I'm telling you is stuff I do for my own business. I want to run the business in a way that I can leave, and maybe not everything's where I want it to be. It's not everything's where I want it to be, but at least I know.
Yeah, absolutely. Yeah, you'll all get the spreadsheet when I send out the landing page. So I promise I will get that done before the weekend. Other questions for Doug? Going to give you one more shot at him. Doug will be back at the Build a Better Agency Summit next May if you want to hang out with him in person. And I think he might actually be at Money Matters too in December. So you might make that introduction as well. All right, last time. Questions, anybody? All right, Doug, thank you so much as always for sharing your expertise. Appreciate it very much. And guys, I will get the landing page with the video replay, Doug's deck, and you will also get the spreadsheet. So, all right. Everyone's saying thank you in the chat. So it was lovely seeing all of you. Shout if you need anything. Doug, again, thank you very much. And I'll include Doug's contact information as well. So you will have that as well. All right. Thanks, guys. Have a great week. Talk to you soon.